Welcome, everybody. I see everybody logging in. My name is Nate Hare with Directed IRA, Directed Trust Company. Got a great program for you guys today. One of my most favorite topics to talk about, which is buying real estate inside of self-directed retirement plans. I'll give you guys a little time to log in here. I appreciate you guys joining in. If you guys are on, just curious, if you are first time you've been to a directed IRA workshop or directed IRA of any sort, webinar, workshop, podcast, give me a 1 in the chat box. And if it's your second or third or fourth, give me like a 2 or 3 or 4, just trying to get an idea of how many people are on here. And I think I have to activate the chat. Give me 1 sec here. That always reminds me that I got to do this. Apologize, guys. Give me 1 sec. Okay. All right, so now you guys should be able to chat. Give me a 1 if it's your first webinar workshop with us. I can see a 1, 1, 1. Awesome. Thanks for coming, guys. See a 2. Thanks for coming back. 4. Loyal fans. I love it. 4, 5 plus. Wow. All right. Well, good. We've got a great audience today. And just some quick announcements real quick. As we go through, if you guys have any questions for me or for Marcus Malika, who is going to be my senior IRA specialist in the background answering questions, if you guys have questions specific to the material for us, type those questions in the Q&A box. We'll look for the questions there. Keep the chat for networking, get to know each other. If you guys are, investment sponsors, we have no problem with you guys saying, hey, I'm so-and-so from Indiana. I do this, this, and this. Contact me here if you guys are interested. So use the chat function for that. But if you have a specific question, you want to make sure that we see it, put that in the Q&A box. We're going to talk a little bit about real estate. We're going to talk about real estate in a self-directed retirement plan. We're going to talk about the tax advantages to doing so. We're going to talk about the different types of plans you can self-direct. And we're going to get a little bit crazy and talk about how you can actually use debt financing to help increase the cash on cash return of your real estate investments inside of your IRAs, your 401ks, or even your HSAs and ESAs, which we'll talk a little bit about here. Before I get into my piece of it, I do have a special guest I want to bring on, Alex Davis with ILS or Legacy. I'll let her explain the actual way that they're going now, but I have a lot of experience with the owner, Tom Berry. Alex, you want to jump on here so we can see your lovely face? There she is. All right, so I'm going to say this. You cannot go to an event in 2024 and not see Alex or ILS. They are everywhere. And I've known the principals, Tom Berry and Donald Sutton for, gosh, ever since I got into the self-directed IRA business. They were like the first guys that I met. Both very, very savvy real estate investors. Tom Berry talks about how he jump-started his real estate career by using other people's self-directed IRAs to help fund his deals, and pretty much got to a point where he couldn't find enough deals to place all this money that people had in self-directed IRAs that they wanted to invest in real estate. So he started some different companies and he started a fund. And now you guys have several different resources at ILS that you guys offer to real estate investors of all sorts. So Alex, tell us a little bit about what you guys do for investors all across the country.
Hi, I'm Alexandra Davis with Investor Lend Source and ILS Capital. We are a premier real estate hard money lender and investment company. I personally aid in helping investors leverage their 401k and self-directed IRA to invest in real estate notes, and funds. This is a powerful alternative to the stock market and puts you in control of your financial future. This enables you to choose investments backed by actual tangible assets. Regardless of whatever your risk profile is or whether you prefer active or passive investing, there are real estate opportunities tailored to help you grow your real estate retirement accounts tax-free. So it's all about partnering with the right custodians like Directed IRA and investment companies like ILS, and together we can help you realize your financial goals.
So let me just say this, because there's a lot of different ways that somebody can invest their IRAs or their 401ks into real estate. I know from experience over the 12 years I've been in this business, a lot of people go in with the intention of finding real estate for their own accounts, but then they find out it's not that easy to find real estate, especially if you're working a 9 to 5 job, you got other things to do, you've got kids, you're away for the summer. Most people actually gravitate towards a little bit more of the passive side. And, again, I'm not endorsing anybody. I can never endorse anybody, but I will tell you, I've seen the due diligence packages that they put together on the loans that they give to real estate investors, and it's the size of a phone book. If you are not doing that level of due diligence, you might want to think about partnering with somebody who can do that level of due diligence, and that's something that you guys do at ILS as far as one option. But you also offer lending or loans for people if they're flippers or buying investment property, and which is pertinent to this program, you also offer non-recourse loans to IRAs. Tell us a little bit about that.
Okay, so there's a whole lot there. So
Yeah.
on the passive side, we do have notes that we originate in our hard money lending company. We do it all with 100% private capital, meaning we have no bank lines. Our due diligence is very lengthy, as Nate mentioned, and we definitely do our homework. So we offer investors the ability to buy notes individually, or if you'd be prefer to be part of a fund and own a portion of a portfolio of notes, we have that opportunity as well. And we handle everything on the back end. There's nothing like mailbox money. It's just easy peasy. You can have a 9 to 5 job and, just have that money in the bank and working for you. We also give the opportunity to take the monthly distributions or to compound. So it's really good for wherever you are. Now, if you're using your self-directed IRA, unless you're on mandatory distributions, you probably just want to compound it and watch it grow. So that's really one of the things that I push for our IRA investors. Now, if you're a little bit more active and you're still, in the middle of the game and you really like being active, we definitely do loans to real estate investors who are doing fix and flips or rentals. These are non-recourse loans, and because they are non-recourse, we actually just lower our LTV about 5%. So if our LTV for a specific product was 70% ARV or LTV, then you would be at 65. And we just wouldn't do the personal guarantee in that case.
And we'll talk a little bit about this as we get into the program. But if you guys are not familiar, I'll just tell you, your IRA can borrow money. You can borrow money, but your IRA can also borrow money if it's buying real estate. And oftentimes, this can be a good strategy for you if you want to buy 3 investment properties instead of 1. The opportunity to leverage other people's money through debt is something that every real estate investor, whether they're inside or outside their IRA, should at least consider and at least understand the ins and outs of it, which we're going to talk about today. But again, if you're going to be more of the passive part, I mean, that's something that Alex has for you guys as well. If you're interested, again, not promoting investments, but they have different ways that you could participate in notes, whether you're investing in a individual note or a pool of notes. And where are you guys mostly buying your notes? Are there certain states that you guys are focused on, Alex?
Yeah, so we focus on business friendly states. So that's kind of the Sun Belt South. You'll probably never see us do a loan in California or New York.
Yeah.
Just not very business friendly. We like nice foreclosure laws. And even though we do our due diligence, foreclosures do sometimes happen. And so we do everything we can to mitigate that risk. And for our accredited investors, we actually have a few more safeguards. But yeah, so business friendly states, we do a lot in Texas, Florida, everything over Texas, Florida, up through the Carolinas.
Awesome. So if people want to get in touch with you, what's the best way to get in touch with you?
Yeah, so I just put in the chat. If you're looking for non-recourse loans, the best place to go is to ils.cash. That is our lending company, and there it kind of tells you a little bit about all of our programs. And there's a quick contact us blurb there that can put you in contact with our loan origination manager to get more information. And then for passive real estate investment opportunities, such as the funds and individual real estate notes and things along that nature, You can reach out to me directly at 979-541-1259, or you can visit the website don'tbuystock.com.
I love it. I love it. We have one question in the Q&A, so and I know the answer to this, but I want you to tell everybody, do you have to be an accredited investor to work with ILS?
So if you're borrowing money from us, you do not have to be an accredited investor. Now, if you're wanting to invest with us on the passive side, yes, at this point in time, you do have to be an accredited investor. However, we are in the process of coming up, working with the SEC. We're going to have a Reg A Plus fund that we are hoping to bring to the public later this year, and that will allow us to take accredited and non-accredited investors.
Awesome. And if you could type the phone number in the chat, there's a couple people that wanted the phone number again. And if you could just repeat it one more time for the people listening and not typing.
Sure, it's 979-541-1259, and I put it in the chat as well. So
Okay. Thanks, Alex. Appreciate your time and all you do
thank
for the
you.
investors. So you guys reach out to them if you're interested. And I appreciate Alex's time. We'll probably see a lot more of them in the future. So I'm going to jump in now to my piece of the presentation. And just as a reminder, if you guys have questions, type those into the Q&A box. I've got my senior IRA specialist on as well, Marcus Malika. So if you guys have questions, you do not have to wait for me to answer them. Just type them in the chat box. He can probably answer 99% of the questions, but if they're good questions to take during the program, he'll just stop me and take those, and then we'll try to take the remainder of the questions at the end. So let me jump into this, share my screen here. And Marcus, tell me that if you can see this, make sure I've got everything on there. If you can't see it, let me know, Marcus, but we're going to jump in. Okay, cool. We're going to jump into it. We're going to talk about buying real estate inside of an IRA, 401k, or even an HSA or an ESA. We're going to talk about how to buy it with debt and without debt, and what are the differences when you do bring on debt with your real estate investments inside of an IRA. We're going to start basic at first because I know we've got a lot of ones on the line. So I want to make sure I at least tackle what is a self-directed IRA? How is it different from my IRA at Fidelity or Charles Schwab? How does it work? How do you buy real estate inside of an IRA? What's it look like? We're going to tackle those questions at the beginning, and then we're going to talk about. I've got 3 case studies. 2 of them are brand new about how you can utilize debt and what that looks like when your IRA or your 401k or even HSA is the borrower. As a reminder, at Directed IRA, we never give tax, legal, or investment advice. We're a custodian of retirement plans, but we're not advisors. We're never in the business to tell you what you should or you shouldn't invest in or give you investment advice. What we provide here at Directed IRA is the vehicle for you to invest in the things that you're knowledgeable about, which can be a lot of different things, which we'll talk about here in a second. But we are not privy to give you guys tax, legal, or investment advice. Everything here is for education purposes only, and hopefully get your wheels turning so that you can make better decisions for yourself when it comes to your retirement assets. A little background about me, how I found self-direction. I actually was in real estate back in 2004 is when I got into real estate for the first time heavily. I started out as a residential loan officer, buying my own real estate at the same time. I had about 17 rental properties. I loved real estate. I loved the money. I didn't like the active piece of the real estate. I didn't like being a landlord, but I still like being a lender even to this day. Now, it wasn't until 2012 that I was recruited by a self-directed IRA company out of Texas. And I didn't even know what a self-directed IRA was. I had never heard of it. None of my friends ever heard of it. But when I started to learn about what a self-directed IRA allowed you to do, I thought everybody and their grandmother should understand that this is an option to most people. Because most people, like I was back in 2012, I thought my IRA and my 401k could just buy stocks and bonds. I thought that was the only investment option. And that's how I was taught to retire. I was taught to work at a corporate company, have a 401k, put money in the 401k, let somebody else invest it, and voila, I wind up like that couple on the commercial driving a sailboat. Come to find out, it's not that easy to retire, especially when you're putting the investment decisions in the hands of somebody else. Now, I was more familiar with real estate at that time than I was in stocks. Even to this day, my bread and butter is real estate and specifically lending. So my knowledge base helps me grow my retirement because I found out in 2012 that I can not only invest my IRAs into stocks, but I can invest my IRAs into real estate or notes secured by real estate, which is primarily what I do today. So this was eye-opening to me, and I get a lot of great passion teaching this to other people because I find that only about 5% of Americans even know what a self-directed IRA is, and even less of a percentage that actually use self-direction on a day-to-day basis. So we try to make self-direction easy and understandable, and we'll talk a little bit about how the process works so you can understand if you're still trying to learn this and trying to conceptualize what a self-directed IRA is. I represent a company, Directed IRA or Directed Trust Company. We're a licensed custodian out of the state of Arizona. We are the only licensed custodian to hold self-directed IRAs in the state of Arizona, but we hold clients' assets from all across the country. If you think about it, we're a custodian just like a Fidelity or Charles Schwab. We both hold assets. The only difference is we hold different types of assets at Directed IRA than you hold at Fidelity or Charles Schwab or Wells Fargo Advisors. Because really, in the tax law, when it comes to the assets you're allowed to own in a retirement plan, you can own almost anything you can hold title to. The only thing is the assets you want to hold, you need to find a custodian for your retirement plan that will agree to hold those assets. But as far as the asset options you have with a retirement account, it's everything under the sun except for two assets. The only two things you are not allowed to own in a retirement plan, IRA, 401k, 403b, or otherwise, is life insurance contracts and collectibles. Those are the only two investments restricted by the IRS. They don't want life insurance contracts and collectibles. Anything else is fair game. If you want to define the types of assets, well, we define it. Here's kind of the industry terms we use. We have traditional investments and alternative investments. Traditional investments are the things that we all know about. And we see them on TV every day: stocks, bonds, mutual funds, ETFs, REITs, CDs, and so forth. Those are investment products. And the reason why Fidelity restricts you from investing in only those types of assets is because they're a licensed securities broker. They make money selling investment products. So if you have an IRA at a Fidelity or a Charles Schwab, they're not going to allow you to invest in things outside of what they sell and what they make money on. It doesn't make them bad people, it doesn't make them bad guys. That's just the nature of their business. So most people go walk around thinking those are my only options because that's all I see Fidelity, or that's all I see that I can buy in my Fidelity account. When really you can buy anything you can hold title to. Okay. If you have an IRA at Directed IRA, rule of thumb is that IRA is no different legally than an IRA at Fidelity. The only difference is the types of assets will hold inside of the IRA you set up here. Now, in our account agreement with our clients, it basically says you invest in anything the IRS allows, we'll buy it on your IRA's behalf, but you have to tell us what that investment is. And when we have an agreement that's that wide open, we can hold all sorts of things inside of a retirement plan here at Directed IRA. Here are some of the most common investments that we see held in our clients' IRAs here. Real estate is obviously one of them, which we're going to talk about today. Land and livestock, precious metals, gold, silver, and other types of palladium, bullion, all that type of stuff. Cryptocurrency, investments into private businesses, so startup companies that aren't publicly traded. Energy, natural resources like mineral rights and oil and gas. Those are available options. We've seen a rise in those in the past couple months. Tax lien certificates, promissory notes, private stock, and we're going to talk a little bit about other types of real estate investments, creative real estate investments. But really, anything under the sun can be owned inside of your retirement plan. You just have to find a custodian that's willing to hold the assets, buy the assets when you find them, and work through the custodian as you buy, sell, and take distributions. It's no different than when you buy a stock at Fidelity. When you buy a stock at Fidelity, Fidelity buys the stock in the name of your IRA. When you buy real estate in a Directed IRA, we buy the real estate in the name of your IRA, but you have to tell us what that real estate is. And we'll talk a little bit about how that works here in the process. Now, when you hear this term self-directed, though, don't get confused. Self-directed is just a marketing term, and it's used really loosely in the industry. We use it at Directed IRA because we find that our IRAs, even though they're the same at Fidelity, they're even named the same, traditional Roth, SEP. We'll talk about that in a second. But when you hear self-directed, it's not a type of IRA. It's just a marketing term. Self-directed to us means you have to find the investment. You have to do the due diligence. You have to tell us what that investment is, and we'll buy it on behalf of your IRA. There's a lot more work involved on your part if you want to self-direct. But don't get confused. Vanguard has a self-directed IRA, but guess what it's self-directed into? All their wonderful mutual funds that you can pick. So again, people use that term very loosely, but just realize it's just a marketing term. An IRA is an IRA is an IRA. There's not even a type of self-direct is not even a type of IRA. We just have IRAs, and these are the IRAs that we have here at Directed IRA that can be, quote, self-directed. We have three categories of plans. I'm just going to touch on these and then I'm going to get into the case studies here. But we have three categories of plans that you can set up here at Directed IRA to buy, own, and hold alternative assets like real estate. Your personal plans would include traditional IRAs, which include rollover IRAs as well, and Roth IRAs. We have employer plans. If you're self-employed, you have additional options for self-direction. You can also set up, fund, and self-direct SEP IRAs or even the mighty powerful solo 401k. We'll talk a little bit about the solo 401k as well when we get to the borrowing money piece of the equation. But you can also self-direct non-retirement plans like health savings accounts and even a Coverdell education savings account, which long story short, they work like Roth IRAs in the sense that distributions come out tax-free, but the distributions out of an HSA come out tax-free to pay for your out-of-pocket health expenses like prescriptions, glasses, dental work, vision, holistic medicines, acupuncture. ESAs are an education savings account you set up for your kids or your grandkids that can be self-directed, but the distributions out of an ESA can be used tax-free to pay for tuition, room and board, books, computers for your kids, iPads, your home internet bill. There's a lot of different ways that you can use self-directed plans, not only to save for retirement in a tax-free manner, but also save for health expenses and education-related expenses that you might be incurring today. When you look at these plans, you want to envision that these plans are buyers, okay? Each of these plans, by definition, is a tax-exempt trust. You put money into the trust, you invest the trust, but your benefit comes from the distributions you take from the trust. Don't get confused that the money in your self-directed plans is your money. It's not yours until you take distributions. So think of these as buyers. That's going to be important as we get to the process of how to use these buyers to buy real estate. And truth be told, most of our clients have not only self-directed plans here, but they still have an IRA at Fidelity or Charles Schwab to hold their paper assets. There's nothing wrong with having multiple IRAs. You're actually not even limited to the amount of IRAs you're allowed to have. So quite often you see our clients have a Roth IRA at Fidelity that holds some of their stocks. They have some of their Roth money here in a Roth IRA that holds their rental properties, their land, their promissory notes, their investments in the syndications or cryptocurrency. You can have multiple IRAs and move money back and forth between different custodians, depending on what you want to invest in. Remember that distributions, the way that you take distributions is the key and where the magic happens, especially when we insert the asset of real estate. Now, one of the things that real estate gives us that I don't think you get with stocks is real estate comes with appreciation. It also comes with cash flow if we're talking about rental property. We're talking about multiple streams of income when we talk about real estate. Now, when real estate is owned in a retirement plan, remember, even a traditional IRA grows tax exempt, meaning I can buy and sell stock in a traditional IRA. And when I sell it, I don't pay any capital gains tax when I sell it. I may pay a tax on the distributions I take from my traditional IRA, but that might be farther down the road. And hopefully, I'm in a low tax bracket if I'm doing that with a traditional IRA. But a Roth IRA works much differently when it comes to taxation. I could buy and sell real estate owned in a Roth IRA, and not only are there no capital gains tax to be paid, but if I wait until 59 and a half before I start taking distributions from my Roth, and let's say it owns a rental property that's generating rents, I could take tax-free, penalty-free distributions from my Roth for the rest of my life, provided I have a Roth open for 5 years and I'm above the age of 59 and a half. That's called qualified distributions. And if you can get to a point to where you have a large Roth IRA with qualified distributions, you can live tax-free for the rest of your life. I'll give you a quick example. I have a client that owns 12 rental properties in his Roth IRA. Okay. They're not owned by him, the taxpayer. They're not owned by his LLC. They're owned by his self-directed Roth IRA. So every month when the tenants of those properties pay rent, they pay rent to the Roth IRA. Okay. Since he's above the age of 59 and a half, he gets to take a tax-free, penalty-free distribution of those rents every single month the rents come in. Now, on 12 rental properties, he's getting nowadays roughly about $20,000 a month in rent. Now, imagine that for a second that you're in retirement and you get to take $20,000 tax-free, penalty-free distributions of just the rents, and you never have to touch the principal balance of your retirement plan because the principal balance is the equity in the property. So it's kind of interesting. He takes about $240,000 of tax-free distributions because he owns all these properties in a Roth IRA. But meanwhile, when we get his account statement at the end of the year, his account is worth more than it was 12 months prior because the value on his properties are going up. Now, if you can work yourself to a point to where you've got a large enough Roth IRA, I always say, why would you ever do an investment in your name again? You pay taxes on every dollar you invest. Your Roth IRA doesn't. So if you can work to a point where you have a sizable Roth IRA, you don't need to take the distributions of the assets. Let the assets pay for your living, especially if they're cash flowing, producing real estate assets. Now, there's another thing with Roth IRAs I want to mention too, and it's if you're interested in passing on more generational wealth to your kids, generational wealth with real estate in a Roth IRA is a wonderful, wonderful thing to leave as a legacy to your kids or your grandkids. That same client, for example, he's going to leave those 12 rental properties that are owned in his Roth IRA. Those will be, when he passes, those will be moved into an inherited Roth IRA with his kids as the owners. And those assets don't disappear. They actually continue to grow tax free and generate cash flow tax free for another 10 years. And his kids won't have to pay a dime in taxes on any of the income, even if they sell all the property. So, this Roth IRA, it's a wonderful, wonderful tool. But you want to think if I'm going to put real estate in an IRA, and also if I'm going to start using some creative techniques like seller financing, buying property subject to, or just borrowing money from a non-recourse lender, I'm going to want to think if I'm increasing my cash on cash return, do I want to pay taxes on that cash on cash return increase in a traditional IRA? Or would I rather pay taxes now, convert what I have to a Roth IRA, and then do those aggressive cash on cash return type investments? So just think about that. Again, you've got Roth IRAs that have tax redistributions. You've also got HSAs and ESAs that have tax redistributions as well. And quite frankly, when I invest, I partner my Roth IRA with my HSA and sometimes even my niece's ESAs because those are all the accounts that come out tax free when I need to use that money. So you can partner accounts together too. You can partner different accounts. I think you maximize your tax savings when you utilize all the accounts that you can qualify for. So back to that the page where I had 6 accounts. You want to look at that as like how many accounts can I have? Can I have a Roth IRA for myself? Can I have a Roth IRA for my kids? We have a promo right now for kids who have earned income. Even if you're 6 years old, you can have earned income if you're working for your parents' company or doing something. We have a promo right now for minor Roth IRAs. You want to think about all the different types of buckets that you can use to self-direct to get Uncle Sam off of your back, and you can partner accounts together as you buy different types of investments. So why is real estate so attractive? Why do we talk so much about real estate when we talk about retirement plans? Well, one thing is real estate is a tangible investment, much different than a stock, right? I think most people understand that. You invest in a stock, that company goes belly up, you have no recourse, you have nothing, you have a useless piece of paper. But when we invest in real estate's a hard asset. It's like this desk here, right? I can drive by, I can touch, I can feel my real estate. Now, if my real estate burns to the ground, hopefully I have insurance on that property, but insurance companies will insure tangible assets. So there's always something tangible about real estate that you don't get with stocks. But even if my property burns to the ground and I don't have insurance on that property, I still have land. And land's not going anywhere. And oftentimes, this is what the true value in it, owning real estate in a retirement plan is. Yeah, you can make hopefully better returns, but some people just invest in real estate through a self-directed IRA because they want assets that are tangible and they don't want all of their retirement invested into stocks or mutual funds that can have a 401k turn into a 201k overnight, depending on what's going on in the economy right now. So tangibility is an important thing when you think about your retirement assets. Self-directed IRAs, investing in alternative assets also give you a little bit better diversification. You can diversify your assets into alternatives with a self-directed IRA, not have all your eggs in one basket. The tax savings is huge. Remember, investing with an IRA, you're always going to grow that bucket much faster than trying to grow your own money as a tax paying individual. Now, this does not mean you should not invest in real estate outside of an IRA. I think the most savvy and successful investors that I see invest in real estate outside of their IRA, but they also invest in real estate inside of their IRA, especially if they understand how to make money on real estate. Now, obviously, there's some tax advantages to investing in real estate outside of an IRA, but don't listen to the CPA that says, I would never buy real estate in an IRA because you don't get depreciation. If you're thinking about your retirement assets, first of all, what do you use depreciation for? Depreciation is to offset tax. If there's no tax in an IRA, what do I need depreciation for? Now, yes, I should have some investments outside of my IRA that give me depreciation if I have the income to depreciate against. But as far as my IRA goes, my IRAs are not taxpayers. There is no depreciation to use because there's no tax. So when you think about your investments in your retirement plan, you just want the investments that are the safest and give you the best return. Whether or not they give you depreciation or not, that's a mute point, right? So I love the CPAs that tell me that, oh, why would you buy real estate in an IRA? So are you telling me I should buy stocks instead? Something I know less about, that I make less of a return, I should invest in that just because I don't get depreciation on my real estate in an IRA. So it's kind of a funny thing, but remember, tax savings in an IRA, you're going to grow money a lot faster, and you have the opportunity to take tax-free distributions at the end of the road and still have those assets owned in, say, a self-directed Roth IRA. Beautiful thing, and you can pass generational wealth on. But a self-directed IRA at the end of the day just lets you invest in what you know best. And I think that's the most powerful thing when you're investing any bucket of money, whether it's a retirement plan or not. So, Marcus, any questions so far before I get into the case studies? Or are we good to get onto the case studies?
I think we can get on to the case studies. We do have one question in here. I can read it to you if you want to do it real quick.
Fire away.
Recently rolled over my 401k into a self-directed traditional IRA. I wanted to convert that into a Roth, but I have to pay tax on the full amount.
Yes. So, well, the full amount meaning however much you convert. I will do a class on Roth conversions because I think it's over. I think it's about time. We get a lot of questions. I have a pretty good class on Roth conversions. But yeah, on conversions, just to let you guys know, anybody nowadays can convert traditional IRAs to Roth IRAs. There's no income limit like there used to be back in 2010. There used to be an income limit on Roth conversions, which is paying tax on some of your traditional funds to convert it to a Roth IRA. So anybody, regardless of their income, can have a Roth IRA through conversion. Now, what I usually tell people is you should not convert your traditional to a Roth IRA just to pay taxes and have a Roth IRA. I think the ultimate trump card on the question that should be asked as to whether or not you should convert is, what am I going to invest in? the investment should drive your determination as to whether or not you convert. Now, oftentimes I see investors invest in real estate that has high return, double-digit returns, even note investors. Like I do private lending out of my self-directed retirement plan. I make 12 to 14% annualized annual returns, and I compound my interest. For me, I don't want to do that type of investment in a traditional IRA because ultimately all that compounding effect, all that double digit returns, I'm going to have to pay taxes on when I take a distribution. So the only person that really likes that is the IRS. When I do that same type of investment in a Roth IRA, right, even if I do it through conversion, I pay the taxes before I do the investment. And again, you can convert as much as you want. There's no limit on how much you convert. The only thing is you have to pay the taxes on whatever you convert. Now it's just treated as income for the year. So give you an example. If you converted $50,000 today, you don't pay the taxes on 50 grand today, but you'll get a 1099 come January from the custodian that does the conversion, and you'll just use that and add that to your adjusted gross income, and you'll pay normal income tax on the amount that you convert. So there's a little bit of a strategy there. I mean, obviously you can look at your tax bracket, and some people say they get to the end of the year and they go, I think I can afford to convert $25,000 and it won't put me in the next marginal tax bracket. You could do it that way, but ultimately I think if you have a good investment that's profitable, you should probably convert before you do that investment, regardless of what tax bracket you're in. I had a client that converted $200,000 before he did the first investment in his self-directed account. Now he had a traditional IRA. He was already in the highest tax bracket, 37.5%. So he knew he was going to pay nearly 40% on any conversion he did. Now, the reason he did that in the year he had a lot of income is because the investment that he found for his self-directed account was a flip in an area that he already had flipped 4 homes personally. And the reason that he found this property was a motivated seller who their buyer fell out of escrow and they needed to close on their house in the state that they were moving to, which their family was already there. So they needed to like get out of the house within like 2 weeks. So the investor knew walking into it, he was getting it below market value. He also knew how much he needed to rehab it for and what he could resell it for. So he saw the potential of some significant gains. So he wanted to do this in a tax-free Roth IRA instead of a taxable traditional IRA. So long story short, he converted $200,000, paid taxes on 200 grand. When he did this investment, this flip in his Roth IRA instead of traditional, remember the taxes have been paid. He made 72% return on the flip. 72% return, and he did this in 8 months. So for him, it was just a math problem. He said, I'll pay 37% in taxes to convert it, but the investment's going to make me 72%. I'd rather have the 72% tax free, knowing I got to pay this tax either today or tomorrow. I'm going to pay it today. So ultimately, you should look at that as an opportunity. Anybody can do it. Again, we don't know how long that opportunity is going to be there. They always toy around with like putting the income limit back on conversions, but yes, conversions are a great tool. I think everybody should look at it, especially if you're gonna, invest in real estate. So let's talk a little bit about real estate, just as a process. For those of you who are new, how does this actually work? How do you take your IRAs, your 401ks, old employer plans, and actually invest it into real estate versus stock? Well, first, you have to kind of identify what you want to invest in. We had two clients, Dan and Denise. They knew that they wanted to buy a property in their neighborhood that they could just flip. They were active, they were getting to be active investors. They had flipped a couple properties outside of their IRA, and they had old jobs that had rollover IRAs that they had just sitting at Fidelity. Okay. Dan had a traditional IRA, Denise had a Roth IRA. Now, when they want to buy real estate, they have to move it to a custodian like directed IRA that will allow them to buy real estate with their IRA. So step one is they just go online or they contact Marcus and say, I need to establish a traditional IRA for myself, and I need to establish a Roth IRA for my wife. You fill out an application. It's no different than filling out an application for a traditional Roth at Fidelity. The next day, you'll usually get a welcome packet in the mail saying, congratulations, your account has been opened. Here's the next step. The next step is funding the account. There's 3 ways to fund a self-directed IRA here at Directed IRA. You can either transfer some money from another IRA, which means just filling out a transfer form. We fax the transfer form to Fidelity in 3 business days. Fidelity usually wires the funds directly to the IRA here. Those transfers aren't even reported to the IRS. It's not a taxable event. You can move money back and forth between IRAs. All you usually have to pay for is a wire fee to move money back and forth. That's the most common way we see clients fund their self-directed IRAs here. But you can also fund it through a rollover. If you have an old employer plan, like if you just leave a job, you've got a 401k or a 403b, you can roll that money into an IRA. It's really just another way to move money from one retirement plan to another, but we're moving it from a 401k to an IRA, which involves a distribution from the 401k and a rollover contribution to an IRA. Those are reported to the IRS, but if you're doing the entire amount as a direct rollover, there's no tax consequences to you, so you don't lose any money through the rollover. The other way that you can fund an account is just through a contribution. You could just make an annual contribution to the IRA here. And there's obviously contribution limits that you have to abide by. If it's a traditional or Roth, it's $7,000 if you're under 50 for this year, 2024. $8,000 if you're above the age of 50 is the max contribution. And don't get scared. You don't need hundreds of thousands of dollars to invest in real estate. I have a client that bought 3 warehouses with $6,000. That's on another program, but those are the 3 ways to fund your account: transfer, rollover, or contribution. And then here's where the self and self-directed part comes from. You have to find the investment. And really what you're doing is you're quarterbacking the investment by including us, your IRA custodian, to actually sign off on the investment, purchase the investment, and hold the investment in your retirement plan. Now, what we do not do is we do not hand you the money out of your retirement plan so you go buy real estate yourself. That would be considered a distribution. And distributions most commonly are taxed and penalized if you're talking about a traditional IRA and you're under age 59 and a half. So we're not doing that. We're not handing you the money to go buy real estate. What we're doing is we're taking your instructions on the property you find, and we'll talk about how those instructions work. But ultimately, we're going to exchange your IRA's asset of cash for an asset of real estate, just like Fidelity exchanged assets of cash for assets of stock. Now, how you instruct us to buy a piece of real estate when you find it is you're going to still do the same legwork when it comes to negotiating with the sellers of the property, right? We're not going to participate in any negotiation of terms. That's where the self and self-directed part comes in. Where you include us in this process is you're going to have your IRAs listed on the contract as the buyers, okay? Because the buyers are going to be your IRA. When it comes to putting the buyers on the contract, typically the buyers would read something like this: Directed Trust Company, which is us. FBO stands for the benefit of. Dan Jackson's IRA, and we have another IRA that's a buyer, because remember, these are 2 different accounts. The other buyer on the contract should read Directed Trust Company, FBO, Denise Jackson's Roth IRA. Now, we have to sign that contract as your IRA's custodian. We're not going to tell you the investment's good or bad. We're just going to sign whatever you need us to sign. Okay. And then you also accompany that contract that we sign with what's called our direction of investment form. This is just our internal form that you fill out with any investment that you do. And we have specific forms for specific investments. You fill out our real estate direction of investment form, and it just lays out the details of the investment. How much am I buying it for? Is there earnest money involved? Where's the wire supposed to be sent? What accounts am I using? So with that form and with the contract, you now have us involved as the custodian to help buy this property in the name of the IRAs. Okay, so we sign the contract, we take the instructions, which in this case were to send a $5,000 earnest money directly to the title company. And just to back up a little bit, these 2 IRAs were partnered at the beginning 50-50. They both moved $150,000 over from the traditional IRA of Dan's and the Roth IRA of Denise. And on the contract, they're gonna split the ownership of this property 50-50. It doesn't have to be 50-50, but you got to abide by the percentages when you're dealing with partnering different types of IRAs together. You got to stick to those same percentages when it comes to paying expenses and receiving income. So in this case, they made it really easy. They go 50-50, which means when we have to send a $5,000 earnest money to the title company, it's going to be one wire from Directed IRA, but it's going to be $2,500 from Dan's account and $2,500 from Denise's account. And that's going to go straight to the title company. But we work with Dan and Denise also all the way through the closing. If there's any documents that we need to sign as the buyer, we'll sign that on behalf of their IRAs. And when it comes down to the funding of the investment, we will fund that investment 50-50 and give the remaining proceeds directly to the title company. Okay, very important. We're just working through the title company to take ownership of this property. Now, when the title company records the deed in this particular example is going to show ownership as directed trust company for the benefit of Dan Jackson's IRA to the undivided interest of 50% because he's partnered 50-50. The other 50% owner would be Denise Jackson's Roth IRA. If you want to test this, go on your county assessor's page right now and just type FBO and look for all the property that are owned in your county in people's self-directed retirement plans. You'll be shocked. You'll see Equity Trust FBO, Quest Trust FBO. You might see some Directed Trust Company FBO. But what we hold here at Directed Trust Company as evidence of the investment is the deed, just like Fidelity holds stock certificates. So we just hold a different type of document. Now, important to know is when you have expenses or you have to collect or you have to collect income, all of that income must flow back to the IRA. None of that income can be deposited into your pocket. Remember, you're not the owner. If you want to take distributions from the IRA as a form of your benefit, then you can do that. But you can't have renters pay you the rent. The rent has to come either through a property manager that holds it and sends it back to the IRA or some sort of intermediary entity, which we'll talk in a second. But very, very important. It's prohibited for you to steal the profit from your IRA directly without taking a distribution. So, and anytime you may need to pay an expense, the expense needs to come through us if it's done this way. So in this particular case, they needed to pay a contractor 20 grand. So they fill out a payment authorization back to us and they give us wiring instructions where we sent $10,000 from each account and their contractor got work done and rehabbed this property. So at the end, they sold this property for $270,000. They only used about 25,000 of the 30 that they saved in reserves for repairs. I'm sorry, they bought it for 270. They sold it for 405, which gave both Dan and Denise 50. Again, they split the profits 50-50, 29, basically a 30% cash on cash return on their investment. But remember, the difference is Dan will be taxed on those distributions when he takes distributions. Denise will not because it's a Roth IRA. So the other way that this can be done too is it can be done through an LLC. Now, very important, you do not need an LLC to hold the assets of your retirement plan. You can own assets directly in the name of your IRA. But if you're doing investments, I say that have a lot of moving parts, maybe you've got it's a large rehab, you got to cut a lot of checks. It could be onerous to deal with us to cut every single check and deal with us to that degree. So what some of our clients will do is instead of having their IRAs take title to property, what they've done instead is have our attorney group, KKOS lawyers, set them up with what is called a checkbook IRA owned LLC. Now, just a reminder, this is not a requirement. This is just an option for a little bit more ease of use. If you want a little bit more control, we can set up an LLC for you. It can either be a single member LLC where one IRA owns the LLC, or it could be a multi-member LLC where multiple IRAs own an LLC. I have a client right now working on 12 IRAs that are going to be owners of LLCs because they have a traditional for them. They also have a Roth. Their wife has a traditional Roth. They have 3 kids that have Roth IRAs. They've got a health savings account, a couple ESAs, and they want to just dump all of those funds, all of those taxes get funds into one location, a bank account for an LLC, and they act as the manager of the LLC. Now, very important, you can't take distributions from the LLC. You just act as the manager, but as the manager of the LLC, you have access to the bank account. Okay, we can help set this up for you. You have access to the bank account. So ultimately, at the end of the day, any real estate that you're going to buy in the name of the LLC. Okay, and all the funds get dispersed out of the LLC, which means you could pay contractors out of the LLC. All the rental income can go back to the LLC. And whenever you're done with that structure, then all the money would flow back to the IRAs that own the LLC pro rata based on their ownership percentages. But it makes things a lot easier, especially if you're going to use multiple accounts, if you're going to do multiple investments. A lot of times it's easier for you to have access to it. You don't have to deal with us. We don't even know what's in the LLC once we fund the LLC. But that would be the only investment on our books would be an IRA owned LLC. That LLC can buy one property or 30 properties. It's completely up to you. Any questions, Marcus? I see some questions in the Q&A.
Here's another. Do we have to file taxes and or BOI for each IRA in California?
Again, IRAs do not have tax returns. That's one of the beautiful things about an IRA. There's the income on an IRA to an IRA doesn't land on your 1040. And if you're just buying and selling investments inside of an IRA, no entity, no tax return. Now there is a change if we are going to bring on debt. So that's what I want to get into next. There is a tax that could kick in that could create a tax filing for your IRA only if there is tax to the IRA. And that can sometimes happen when we bring on debt. So let's just jump into that. So first of all, bringing on debt in an IRA situation where an IRA is going to buy property is not a bad thing necessarily. It's a cost of doing business. You want to factor this cost in of borrowing money because you're obviously going to have some interest payments there, but also the tax that you could trigger to an IRA. Now, this is not a tax to you. This is a tax to the owner, which would be an IRA. Now, this tax is called unrelated business income tax. If you look at the definition in the tax code, unrelated business income tax not only can apply to IRAs, but really any tax exempt entity. For example, churches are tax exempt entities. Churches are not taxed on the income derived through the purpose of the church. But if a church opens a bookstore or a cafe, the church has to pay taxes on that income because that is unrelated to the function of the church. If you think about it on those terms, an IRA also is a tax exempt entity. So an IRA will never have to pay tax on the money it invests. But if an IRA brings on outside funds that are non-retirement funds, let's say from a bank with a non-recourse loan, then an IRA is subject to the tax of the income based on the money it borrows because it's unrelated to the IRA. Okay, when do we see this tax, this UBIT tax in an IRA? There's really three circumstances. We're going to focus on number three. One is if your IRA owns a business. Just think about it like this. My IRA owns a Pizza Hut. It would be unfair that my IRA gets to sell pizza tax-free and run all the other Pizza Huts out of business. So if your IRA owns an operating business, an ongoing trade or business where it's considered, the income's considered ordinary income, your IRA has to pay taxes just like other business owners have to pay taxes. The other circumstance is if your IRA owns or leases personal property. Personal property is not real estate. So real estate's tied to the ground. Personal property is not tied to the ground, which include things like boats, vehicles, office equipment, or mobile homes not tied to the land. Okay, that's considered personal property. Owning and leasing personal property in an IRA could trigger unrelated business income tax. But most specifically, and the most common time we see this unrelated business income tax is when an IRA brings on debt. And we're talking about unrelated debt finance income tax now. Now, unrelated debt finance income tax is on any asset acquired or leveraged with debt. So if you, let's say you buy a property, you use 40% down from the IRA, you borrow 60% or $60,000 from ILS lending, that 60% is going to be subject to tax. So let's just make it real simple. I'm 60% debt leveraged on an investment in my IRA. I get a $1,000 rent check to my IRA from the tenant. 40% of that check goes right to my IRA tax-free. The 60% I have to split with Uncle Sam. But here's the thing. My IRA is only taxed on net income, not gross income. So as soon as my IRA becomes a taxpayer because the asset has debt, now I can use, or my IRA can use expenses and depreciation to offset that income and pay a lot less. So oftentimes, at least in my experience, every time I've seen a client utilize debt to help buy more property, after you factor in depreciation and expenses, the income on the annual income on the rents or the lease income is very, very small. Other thing is the capital gains, which we'll talk about here in a second. But this unrelated debt finance income tax can also include syndications or other private entity investments that might be holding debt leveraged investments. But again, not the end of the world. It's just something that you want to factor in to your equation. Now, here's the thing that scares people out of it. And again, this is I'm going to talk about ways around this, but the tax that you calculate your unrelated debt finance income tax on is not a personal marginal income tax bracket. You would have to look at the trust and estates tax bracket if we're talking about tax to an IRA. Now, if you notice here, this is the 2024 official trust and estate tax bracket. You see a lot of the common marginal tax brackets like we see as individuals, 10%, 24%, 35%, 37%. The only difference is you're not at 37% at 400,000, you're at 37% at 15,200. So it is an onerous tax because it gets to the top of the tax bracket very fast. But again, I'm just giving you the examples of what you got to look out for. We're going to talk about how less onerous this is dependent on how you structure your deals. But this is the actual tax rates that you would look at. You would go to the trust and estates tax bracket. Now, I will tell you, the first $1,000 of income isn't even taxed. You don't even have to file any tax return if your IRA owes less or has less than $1,000 of net income, which oftentimes you can do, especially today with the high interest rate market and the fact that cash flow is a lot less than what it usually is. A lot of times you're not even at $15,000, but just something to keep in mind. Now, when your IRA does have to pay a tax, there is a tax form that you have to have your CPA fill out. It's called the 990T. This is the same tax form you see with churches and nonprofit organizations. They also have to fill out 990Ts if they have unrelated business income tax. Okay. Typically, the taxes for an IRA, if you owe taxes on your investment, have to be paid by April 15th. If you have an extension, you can extend that tax liability out to October 15th, depending on the type of entity you have. And in some cases, you might need to get a new tax ID number if your IRA is going to pay taxes and you know that the tax is coming. You can use our tax ID number if you have to. We have a tax ID number for all the IRAs you have. But I will tell you the IRS is moving now to all electronic filings. So it's actually a very easy process if you find or if you have a CPA that finds that your IRA may owe a little bit of tax. Okay. The tax form is the 990T. They prepare it, we sign it, and then you would actually pay the tax out of your IRA. So it's just an expense. You don't have to pay it personally. It's just an expense that you pay outside of an IRA. Now, what do you do about UBIT or UDFI if you find that you might have it? Well, there are some workarounds. If you want to just completely avoid UBIT or UDFI, well, one of the things is just don't own anything. UBIT and UDFI only comes from ownership of a business, ownership of personal properties, or ownership of debt leverage property. So if you want to just avoid it and make your life simple, well, you could just be a lender like me. I don't worry about UBIT because all of my investments are notes. Okay. There's also different structures that you can use instead of using debt. Okay. Maybe you can bring on joint venture partners instead of lenders. Okay. We'll talk a little bit about that. Even a real estate option, different investment structures could eliminate the fact that your IRA actually owns a property, okay, or has debt on a property that it owns. Now, if you're gonna invest into a business, this is more of a way to minimize the tax if you're owning a business. And we do have some clients that own, pretty profitable businesses in their IRAs, and they just deal with the UBIT, but they use a C Corp blocker as a corporate blocker to pay taxes at a corporate level versus an IRA level. Okay. We're not going to talk about that because I want to talk about the debt leverage piece of it. Or you can just find an exemption. One of the plans that has a built-in exemption to paying a tax, specifically UDFI, is a solo 401k or any 401k. 401ks have an exemption to the UDFI tax, specifically debt leveraged investment tax. So if you're going to buy debt leveraged investments and you have the opportunity to do it in a 401k, do all your debt leverage investments in a 401k, you don't even have to pay the tax. It's an easy answer for that. If you don't, again, it's not the end of the world. Pay a tax, even if it's in an IRA. So let me give you an example. Okay. This is a real deal. This is a doctor, physician friend of mine who bought a piece of land, okay, using debt. Okay. First of all, let me tell you the example, the reason why he did this. He found a piece of land that he wanted to buy in his IRA, but he had some of his money working pretty well in his mutual funds. So what he didn't want to do is he didn't want to cash out $300,000 in mutual funds and put it all into this land that he was just going to hold that wasn't going to generate much annual income. He only wanted to use a portion. So basically, what he did is he went out and he found a non-recourse lender. Okay. And in this case, it was his community bank. Now, there's other places you can go, a lot easier places. I'll give you a resource here on the next page. But basically, long story short, he went to his community bank. He talked to his banker and said, hey, my IRA is going to buy a piece of land. It's going to put down, it can put down as much money as you want. Would you be able to give my IRA a loan, non-recourse, for the remaining amount after the down payment? Now, when I say non-recourse, any loan an IRA gets has to have what's called some non-recourse language in the note. All non-recourse means is you cannot personally guarantee debt for your IRA's investment. So in this case, Todd cannot sign a personal guarantee. He cannot be on the hook for a loan on an IRA-owned asset. It has to be non-recourse. All that means is the bank just has recourse to the property. That's it. It's just an asset-based loan. It's not a strange thing. Hard money lenders do asset-based loans all the time where their recourse is the property. Now, in most cases, when a bank only has recourse to the property, they want a larger down payment. And in this case, your IRA doesn't have a FICO score, your IRA doesn't have a tax return, so it only can qualify, the bank can only qualify it on, does it have money to put down on the property? So in most cases, you'll probably see non-recourse lenders at least want about 40% to maybe 30% down on the property. In this case, they said, as long as you put this amount down, we'll finance the rest with a 20-year interest-only note at 6%. So in this case, his directed IRA account was able to buy the property with a down payment, leave the rest of his money in the stocks or mutual funds, still making money. Okay. And he was leveraging money from a bank so that he can hold this property longer than a year and a day. Now, if you want some resources for non-recourse lenders, just go to our website, directedira.com. If you go to the Learn tab, there's a resource directory. You can see some of the non-recourse lenders there. Now, this one, it wasn't done through one of those lenders because most of the non-recourse lenders, they want income-producing property. They don't want land. So you might have a little hard time. He was able to do it through his community bank. That's why I mentioned that, because this was land, and most non-recourse lenders don't want land as the asset. They want an income-producing property like a rental property, small multifamily. Now, remember, you've got two types of income when it comes to your real estate. When it comes to your IRA, you've got your net annual income and you've got your capital gains. Capital gains aren't going to be factored until you actually sell the property. Now, on the net annual income, what's the net annual income on land? There is no income. Right? This is just a buy and hold for appreciation. So he paid no taxes on any annual income. So he paid no taxes. He didn't even have to file a 990T in the first year. But when it comes to capital gains, very important, okay? When you sell the property or your IRA sells the property, the capital gains, the percentage of the capital gains is only going to be the percentage of debt the IRA had over the previous 12 months, okay? Only the debt over the previous 12 months. It's not the debt you started with, it's the debt you ended with in the last 12 months. So obviously, the longer you hold property and your IRA has an opportunity to pay down the debt, well, in a perfect world, if you pay the debt off completely and you own it 12 months before you sell it, you could pay no capital gains. Even if you started with 100% debt leverage, if you pay the note off and sell it 12 months later, you can pay zero capital gains tax on that investment. But if you do sell the property and there's still debt on there, even an IRA gets to use long-term capital gains provided the investment is held a year and a day or longer. So in this particular case, he held this property for a year and a day or longer. He held it for 2 years, I think. So long story short, he bought the property for $299,000. He used a non-recourse loan through a non-recourse lender for $179,400. His down payment from his IRA was only $119,600. Lender's fees and closing costs were about 10 grand. His monthly interest payments to the lender were $897 per month. And 2 years later, he sold the property for $425,000. Here's the breakdown of the profit, the net profit, even after paying the unrelated business income tax. So you can see he got interest payments of 22,000. That's obviously a cost of doing business. The total profit before the UBIT paid was 92,811. Okay, now remember, he's only paying tax on a portion of the profit, okay, and he's paying long-term capital gains on a portion. So it's like a percentage of a percentage. So the UBIT, the total UBIT paid after selling this property from the IRA was 11,137, giving his IRA a net profit after the tax of 81,674. Here's the important thing. His cash on cash return, if you look at the down payment from the IRA of 119,000 and the net profit after paying the UBIT of 81, his cash on cash return on this investment were 68%. Okay. Yeah, he paid a tax, but the cash on cash return, keep that in mind, 68%. What would the cash on cash return have been without the debt? Well, if you go without the debt, his closing costs are less. Okay, you've got a sales price, you've got net profit, which is higher because you have no interest payments and you have no tax. And in that case, it would have been 120,834, but he would have had to come in with $299,000 to buy the property, taking more money out of the stock market and also reducing his cash on cash return down to 40%. So you can see if you're looking at it from that point of view, if you're just scared of the tax, well, you're going to make less cash on cash return and give your IRA less opportunity costs to invest the remaining of that money. So sometimes if debt is used responsibly, you can actually do what he could have bought 2 pieces of land for that case, but could have bought the lot right next door and made another 68% return by just leveraging bank financing and buying 2 pieces of land instead of one. So that's just buying property and dealing with the UBIT. You can also just use time on your side. Here's an example that I've given in the past where I had a client buy 5 properties, all subject to the underlying financing. Now, if you don't know what subject to is basically you find a buyer. I'll just give a scenario. You find somebody who hasn't paid their property taxes or their mortgage. They're facing foreclosure. They might not even have any equity in the property. Usually they do not have equity in the property. And basically buying it subject to says, well, can I catch up your mortgage payments, maybe give you some cash for keys and you deed the property to me and I'll just pay your mortgage going forward? Some people say, well, that's the best solution I've heard so far because all the other people are telling me to short sell it or just get foreclosed on, which will ruin my credit for another 10 years. You telling me you'll just pay my mortgage payment and catch up the mortgage payments and I can even go find another house outside of this? Yes. So here's what my client did with an old rollover traditional IRA from his company, Motorola. Okay, he moved full-time real estate investor, and this is back in 2012. And he started looking specifically for opportunities where he could find properties that had little to no equity, expired MLS listings. So he knew they tried to sell it and they couldn't sell it for some reason. And after contacting the owners, he found out they were in distressed situations. They either lost their job, couldn't pay their property taxes, couldn't pay their mortgage payments. But these properties were all in good areas where the rents at least covered the mortgage. So he figured, well, if I can buy these properties with my Roth IRA, he converted his traditional to a Roth before he did that. Very, very smart. Okay. He said, if I can just take title to property that are in good areas that the rents cover the mortgage, I only have to come in with say 10, 15, maybe $20,000 max to take title to the property. And there's already financing on it. Now, here's the cool thing with financing already on the property. It's already by default non-recourse because it's not recourse to the IRA owner or the IRA. It's recourse to the old homeowner, but you're going to solve that problem by making the mortgage payments and you're going to use the rents on the property to pay those payments. So basically what he was doing is just solving these people's problem with stopping the foreclosure, taking title to property in his Roth IRA, putting his property manager in place to immediately rent these properties. Okay. The rents go to the Roth IRA. The Roth IRA pays the mortgage payment. Okay. He found 5 properties like this over the next 5 years, and he just kept this process going. Roth IRA buys the property with $10,000 to $15,000. There's already debt on the property. Again, you're going to have to face UBIT here. But here's the thing with the annual income, how much UBIT are you paying? Well, now you've got an expense, you've got a mortgage payment, you've got property taxes, you've got maybe some common repairs. His net income was very, very small, especially at the beginning. Okay, it was almost no net cash flow. But what he's holding this is for the appreciation. He wants these investments to just be put on the shelf and have these renters pay off the notes and hold these properties long term. So, long story short, now what he did is he started to accelerate the principal paydowns on these investments by you, if you imagine the debt on these properties, the mortgage payment doesn't change. These were all fixed rate mortgages with really good interest rates. The only thing that'll fluctuate is maybe your taxes and insurance go up a little bit. Rents go up faster than the taxes and insurance did. So as he held these properties, he got a little bit more cash flow that he had in the Roth IRA. What he used it for is he saved a little bit of that money for any repairs that needed to be done, but he also accelerated the principal paydowns of the notes. So he started doing this a little bit more aggressively as he got onto it because he wants all these notes completely paid off. Now he's at a point now where almost all of the properties are the notes are completely paid off through the renters. Okay, they're owned in a Roth IRA, and he's now in his 60s. So now, once the properties are owned free and clear, he can sell all of these properties if he wanted to, and maybe upgrade to a small multifamily, another property. But as long as the debt on the property is paid, and he doesn't sell the property for another 12 months, he'll pay zero taxes on any capital gains. That's taking a $70,000 traditional IRA through a conversion and turning that into a $4 million Roth IRA. And he avoided the U-bit by just letting the property sit, letting time do its thing, letting the renters pay down the note. He paid a little bit of U-bit along the way, nothing to shake a stick at. But this is a great opportunity where he bought 5 properties he couldn't have bought otherwise just using $70,000, because you're not going to buy 75 properties with $70,000 unless you get creative. Now, here's the last thing, and I know I'm going a little over, so I want to race through this, and I'll give anybody the presentation if they want this, just email me. But here's another way that you can avoid UBIT is just by structuring your deal a little bit differently and maybe looking at using a joint venture scenario instead of a borrower-lender scenario. So this is a client of mine. He had 2 Roth contributions. Okay, he had this is back when contributions were $5,000. He made a contribution to his Roth IRA of 5,000. He made another contribution the next year of 5,000. Didn't have it invested. Was kind of waiting to find something creative, and then he found something creative. So he was buying property in, I don't know if anyone's familiar with Houston, but the 3rd Ward in Houston, many years ago. Before everybody got into the 3rd Ward, he was in the 3rd Ward doing all sorts of investments. And he was kind of known in the area for the guy, if you needed help with your investments, you went and saw John. Go see John. John will help you out. If it's any that they knew him in the neighborhood as the guy that can fix real estate problems. So one day he has a lady come in. She's in her 80s. She had not paid the property taxes on her property, and her property was pretty much a hoarder house, okay, in a rough part of Houston at the time. So what he decided to do is he wanted to help the lady out, but he didn't want to buy the property because where's she going to go? He needed help paying the property taxes and needed some time in the house so that she could figure out what she's going to do, because she needed to move in with family. She really shouldn't have been living on her own in the first place. And her house was a hoarder house. I mean, it was an eyesore in the neighborhood. Kids didn't play in the yard. I mean, people stayed away from it. It was a rough place. So what he decided to do is he said, well, I've got $10,000 in my Roth IRA. Okay. Why don't I give you the $10,000 as consideration? Okay. And I want my Roth IRA to have the option to buy your property for the next 2 years. So basically, this is a one-way contract. A real estate option is a contract that you have to give consideration, and you set a purchase price, which in this case was the $10,000 he gave her, and said, I'm going to give you the 10 grand. That's consideration. That's non-refundable to me or my Roth IRA in this case. But my Roth IRA will hold a real estate option contract, and it has the option to exercise this option before 2 years. Okay, there's an expiration date. I have to I have to exercise it before that expiration date. Now he can let the option expire if he doesn't want the house. He can assign the option like wholesaling. You can assign the option to another investor. Homeowner could sometimes maybe come back and cancel the option and say, you know what, can I pay you to cancel the option? I'm going to stay in the house. In this case, she didn't stay in the house. She moved in with family up in Virginia. So now the Roth IRA owns this hoarder house. He exercises the option. He owns a hoarder house in his IRA. What's he going to do with a hoarder house? He's got no more money to do anything with it. So here's where creativity came into play. He said, I need to leverage some other financing and another bucket of money and some sweat equity, because I can't do the sweat equity on this property. So he went and found a construction company who was a good friend of his, not a disqualified person, a good friend of his that owned a construction company in Houston. He said, "Hey, I own this piece of land with basically a piece of land with a hoarder house on it. I'd like to build 2 townhomes on it, but my Roth IRA doesn't have the money. I can't make that contribution to my Roth. I can't come in because it'd be disqualified for me to come in with money and sweat equity. Would you be interested in doing a joint venture with my Roth IRA as the owner of the property? And the construction company comes in with all the construction costs, bulldoze the property, build 2 townhomes, and as a part of the joint venture agreement, the Roth IRA and the construction company would split the proceeds 50-50 at the time of sale." Long story short, they did this. Okay. They built 2 townhomes, bulldozed the property, built 2 brand new townhomes in the middle of downtown Houston, which at this point was an up and coming neighborhood, and all the people were trying to get into the third ward to invest. But the Roth IRA in this case and the construction company split 50-50, net gain of $595,000, netting the Roth IRA $297,653 on his first investment, tax-free and with no UBIT. Because with a joint venture, that's not debt, that's a partnership. Partnerships do not trigger UBIT. So this was a great from beginning to end, using the real estate option as a creative technique to take title to a property, using his knowledge of IRAs and his network of people that had resources that he can use or financial friends to help come in, form a joint venture, and he profited $297,000 tax-free in a Roth IRA. Great job there. So I hope this gets you guys thinking. I hope you guys learned something new today. There was a lot of information that we went over. I'll try to take some questions now. And if you guys want the PowerPoint, just shoot me an email and I'll send you guys the PowerPoint as well. If you guys want to come out and network a little bit with us too, we have our Alternative Asset Investor Summit. We've got early bird tickets on sale right now. Just go to altassetsummit.com. We're going to do a big event, probably 300, 400 people here in Phoenix. Great place to learn about alternatives, great place to network with other investors. Jump to altassetsummit.com if you want tickets there. And I'll take questions now, Marcus.
Okay.
If you got it.
1 second here.
And let me know if this was helpful, guys. If I missed anything, I apologize. I tried to squeeze in a lot of information. And there's a lot more things I can go over, but if this was helpful to you guys, just let me know in the chat.
Nate here, a couple questions. For syndications, how do we know the percentage leverage with debt to calculate UDFI? Is it on the K1 form that we would get?
It wouldn't necessarily be on the K1 form. You'd really have to, talk to your investment sponsor to find out. And obviously you want to get a CPA that's knowledgeable to help factor this in. Now, with most syndications, you always keep in mind too, a lot of people that are invested in syndications, if you're receiving a K1, a lot of times there's not really much net income to begin with. Sometimes you're even running at a loss. And you can carry forward losses too. So as soon as your IRA becomes a taxpayer because the underlying investment has debt, right? If there's losses on that investment, you can carry forward the losses to offset future income. So one of the things I'll just say is, it's no different than investing personally, where you can use those tax tricks like depreciation, carrying forward losses and any expenses. Now, as far as calculating the income, you really have to know what the existing debt on the property is to the value of the property. Now that can change from time to time. Now I will tell you, a lot of syndications, depending on their strategy, is if they're in a value add position. Let's say that they buy a property for $2 million. They do some renovations, paint some VIP parking spots, and do all that stuff. Change out the toilets, and they drive the value of the property up. A lot of times what they do is they cash out with a new loan and get equity to pay off the investors. Now, remember, on the capital gains, okay, if you're paid back at that time, a lot of times you're still going off the old debt leverage percentage, right? And if there's increased value, that percentage might be a lot lower than what you started with. The act of increasing the debt just to pay the investors, that'll only change your debt leverage percentage for maybe 1 month. But remember, they take an average of the 12 months prior to sale. So the reason I'm saying this is because there's a lot of factors that go in your favor, even when you're investing in syndications. UBIT is something that you probably have to pay, but you'd be surprised how low it is as long as you're using depreciation expenses and carry forward any losses. You find that it's a lot lower than you can. And at the end of the day, you want to just factor that in. It's not something to be scared of, but if you're invested in a syndication that has UBIT, is that a better investment than what your other opportunities are? If you're still making more money, even though your IRA has to pay a little bit of tax, and you're making more money on that investment than your stocks, then it's probably a good investment. But again, there's a lot of factors there. I would just say just find a CPA that is knowledgeable about UBIT. I know that's a hard thing to say. I always say that. People say, "Do you know any CPAs?" Man, as soon as I give a CPA number out, it's like they can't receive any more business after that because they get so swamped. I will tell you, Mark Kohler has a CPA network, a tax advisor network. I would probably say go to his tax advisor network, find a CPA that's in your area. And knowing that they went through the education of Mark Kohler, who does a lot of training on real estate investing and how to deal with real estate investors, you're going to find more knowledgeable, I would say, CPAs that understand self-directed IRAs and potentially UBIT and UDFI.
Hey, Nate, one more, just on the recording, are you going to send out a recording to everyone, and when is that available?
Yeah, it usually will be available by the end of the week, and I can send out a recording if you like. Yeah, I'll just send out a recording to everybody by the end of the week as soon as it's available.
Well, that's about it on questions.
Well, awesome. All right, guys. Well, thanks so much. I know I tried to cram in a lot. I might have went fast at the end there, but I want to try to get to at least each presentation. We'll send you guys the PowerPoint. I hope this just gave you guys some stuff to think about, gave you some ideas that maybe you hadn't thought of before. And I will just say, if you are interested, if you are not a client of ours, become a client of ours. We have a promo right now that ends this week. So if you want to open an account and get $150 off your first year's annual fee and you do not have accounts already, email Marcus. Marcus, can you put your email in the chat there as well? Email Marcus or go to our website, directedira.com, book a call with Marcus, have him open an account. Again, think about the accounts that maybe you don't have. If you want to do a Roth conversion, maybe you want to open a Roth this year. Maybe your kids need Roth IRAs if they're working summer jobs. All you need is earned income in order to have an IRA, especially even a Roth IRA. We've even got a more aggressive promo on minor Roth IRAs. So if your kids are working, you want to set up Roth IRAs for them, there's $200 discount on just those. But try to get them open, try to get them set up, guys. Again, it can be life-changing. You really put the keys in your hands to invest in the things that you're knowledgeable about. And I'm hoping education like this shows you do not need hundreds of thousands of dollars to invest in real estate with a self-directed IRA. You just need to understand creative concept. You need to understand how to use leverage and manage around it accordingly. And again, like you see, there's different ways you can structure deals. You could take $10,000 and turn it into $297,000 on one deal if you just have a little bit more knowledge on how to structure your deals going forward. So thank you guys for joining. Our next workshop will be in a couple weeks. I believe it's mailbox money. We'll talk about hard money lending out of self-directed IRAs. I know that's always a big one, but I appreciate your guys' time. Shoot me an email if you guys want the PowerPoint, and we'll send you guys the recording as soon as it's available, hopefully by the end of this week. So thanks, guys. Have a great rest of the week. Thanks for all your help, Marcus. We'll see you guys next time.